I'm Callie on the capital markets team here at Finley. Finley is a private credit management software that helps companies with their asset-backed loans, and they can save time and money by automating those routine debt capital management tasks like generating borrowing bases, verification of the loan tape, and proactive alerting. We're really excited to have Nick, who's joining us here today. Nick is a 15-year fintech veteran with experience on Wall Street and at venture-backed fintech and insurtech startups. Nick, we'd love to hear a little bit more about your background to start.
Yeah, thanks. So my name's Nick Rockwell. Super happy to be here. Like Callie mentioned, I've spent the last 15 years, my entire career in broader financial services, and really the last 9.5 years at 3 different venture-backed fintech startups. The first of which is a company called Funding Circle, which does marketplace lending for small businesses, and is a global company. They're started in the UK, and I came and joined at the end of 2013 when they made their first foray into the US. So as part of that early US team, and we grew that business all the way through IPO in 2018 on the London Stock Exchange. I spent the majority of my time in go-to-market roles, both on the partnership side as well as leading all of our US sales. From there, I spent time at a company called Circle Up, which is a capital provider to early stage consumer brands. So think about high growth consumer startups that you find on the shelves of Whole Foods. And again, was in a leadership position on the credit side. And then most recently was part of the founding team at Ascend, which is an insurtech payments company with a significant lending component, offering premium finance at the point of sale to folks seeking commercial insurance. So very happy to be here, and thanks for having me.
Awesome. Yeah, and great to hear, about the interplay between the go-to-market function and the capital markets part of your role at Ascend as well. I think, that's very common for a lot of fintech startups to think about if they want to launch a new lending product and they want to raise debt alongside that to be able to launch that new product, what's the best way to go about doing that? And so to start things off, would love to hear a little bit about, from your experiences, why debt capital is really important for fintechs to be able to fuel their growth and really progress.
For sure. So I think it's important to make the distinction up front for folks. There are startups that actually provide a lending product as their core offering. And then there are startups, right, that don't. And so both can, access the debt capital markets for a variety of different reasons. I think today we're going to focus a bit more on the former. So that means actually using debt capital in order to extend loans through your startup versus using credit to just fund the working capital of your startup, for example. So just pulling on that thread a bit more, it's not a great use of your VC, your investors' money to lend that out. So if, let's say you're an early stage startup that's raised, I don't know, maybe it's a seed round of $5 million or something like that. If you're going to lend out that money, your VCs want you to spend that money on hiring people, office space, all of the kind of like regular nuts and bolts that go into growing an early stage company versus actually delivering your lending product. That's principally the reason why you might go and seek a credit facility through the capital markets.
Awesome. And yeah, you obviously, we're in charge of leading the $250 million credit facility raise at Ascend with Hudson Structured Capital Management. Would love to hear a little bit about how that process was started, and then also kind of what were the stages that you all went through as you thought about, okay, now's the right time for our company to go out and raise a credit facility, and then also the stages that followed.
For sure. Yeah, I think that there are probably 2 or 3 different buckets of startups that are accessing the capital markets for a credit facility at Ascend. And I think oftentimes you're looking for that first institutional capital as you grow, as you're in a firm or a SoFi or a Ramp or one of those type of companies. You might be looking for your 3rd, 4th, 5th type, different structures, different facilities down the road. But in order to get your first credit facility in place, there are a couple key stages that at least I found important when doing the process. And there's no like real roadmap for this, by the way. So it can be a little daunting. Yeah, it can be a little daunting. I think number one is you need to have as many conversations with what I term as friendlies as you can. And friendlies I would put as not just folks that are, could give you a term sheet or could actually make the loan, but folks that are well connected into that space. And there's a couple good reasons for that. I think number one, it helps you refine your pitch, right? Your pitch is going to be slightly different than an equity pitch that you might give to venture capitalists. Number two, there's no Rolodex or CRM for debt capital providers. So by speaking with friendlies, oftentimes it can lead to further conversations down the road with somebody who you might actually get a term sheet from. So we found that process super helpful. And the last thing I'd say about that particular first stage of the process, make sure you document all of these conversations. Again, there's no index, there's no yellow pages of debt capital providers. I mean, actually what I found is, I was talking to folks that, I had never heard of, right? And that wasn't good or bad. It was just like, I was not in the market all the time and everybody had different connections. So I think having conversations with friendlies in the beginning is the most important first step.
I think that's a great point. That is definitely something for whoever's leading that initial debt capital raise process to really consider are who are the conversations that they're having for that first credit facility, right? Because, oftentimes maybe this is the first credit facility they've ever raised, getting their name out there, meeting with different capital providers, but thinking a few steps ahead, maybe a year from now, they want to raise an additional credit facility, and making sure you're spot on there to have that list of the folks that you've talked to maybe a year ago to be able to then tap into that network later when, maybe you want to raise from a bank party or a larger credit facility down the line. That's a great point to take home.
Let me take that a step further and then talk about the next step. I think also important in that early stage is defining who is going to lead this process, because it is a process, right? It's not something that is going to be completed in a week or two. Typically, completely. These, from the beginning, if you characterize the beginning as like the first sort of friendly call, as I describe it, to like, loan docs actually signed, that can take anywhere from, I don't know, on the very, very aggressive end, maybe 2 months to 6 or 7 or 8 months, right? So it's typically going to be somewhere in that kind of like 3 to 6 month window, based on my experience and talking to others. And so it's important that your company or your startup has defined who is the actual owner for this process. Is it going to be the founder? Is it going to be someone different? At Ascend, the founders, Andrew and Praveen, ceded that responsibility to me and given some of my lending expertise, but that's not always the case, right? Like a lot of times founders run this process as well, and it's very involved. So I think just creating ownership and defining that is important at the first stage as well. I think the second step is after you've had some conversations with, what I was term as friendlies, and sort of taken them up on any introductions that they've made to folks within their network that may be able to actually provide debt capital. And you've sort of documented all of this notes and done that. I would say that it's a good time to start prepping what you call a data room. I think that is a term that is a little bit of a misnomer for early stage or like seed stage startups. It's a little bit more relevant for companies that have like significant loan history that might be seeking that second or third facility, as I mentioned. What we did at Ascend, and I kind of just organically did this, is I just called it a diligence package. You can call it whatever you want, but literally it doesn't need to be something super formal. I just created a Google Drive, right? And as I was having these conversations, this is another good reason to get out and talk to people, I started creating content. And by content, I mean memos, right? Like, what is going to be your underwriting philosophy, right? Just a simple one-page memo that says, here is how we plan to underwrite, here is how we plan to price the risk, da 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 da. Even just drafting that in the form of a document and putting it in that package, I think is super helpful, and also shows the investors that you're credible and you kind of know what's going on. You can put any of your seed funding decks in there. I got asked for things as simple as, just like incorporation documents, origination projections. Again, these are things that like can seem sort of daunting, but actually, I think reasonable capital providers understand that this is a startup, this is the first institutional facility, and they just want to see some thought behind it. So putting together what I call like just kind of a nascent diligence package, data room, whatever you want to call it, is super important, because not only does it give folks something to chew on, but it also like just adds to your credibility and also helps clarify your own thinking, I found. So that I would say is the next step. And again, that could be iterative. It doesn't need to be like, oh, one day I need to have all the friendly conversations, and then the next week I need to go prep the whole data room. I kind of viewed it as like an ongoing dynamic process, where as I learned more about the needs and kind of like, as I took more from these conversations, I would sort of backfill in additional information into that diligence package. And the last thing I'll say about that is that, one of the things that any lender will want to see is performance history, right? So like, how do the loans actually perform over time? The catch-22 with early stage startups is like, you haven't done any lending probably. So this is your first facility. Maybe you've done a few loans, but like, you certainly don't have like, years of origination history to share. So I would say that one thing that helped us at Ascend is getting competitor information in the form of like securitization reports or rating agency, documentation. All of that is basically publicly available, or like one step away from publicly available. It's not too hard to find, but just putting anything that debt investors can kind of like comp to your product in the diligence package, we found extremely helpful. So just a plug for like thinking creatively around like satisfying that kind of loan tape requirement when you don't actually have any origination history.
Certainly. And I think that's, you're spot on in terms of debt capital, especially in the fintech context, can be very opaque and hard to understand. And I think, whoever is running this debt capital raise process for any startup or, any process at any company is really wanting to, in the back of their minds, think about, okay, how will we be able to report on our assets? Or, what are the systems that we currently have in place? Are they properly set up to generate the right KPIs? In the background, right, there's the conversation that I'm sure is going on of, okay, maybe in conversations with capital providers, what are potential rules that the company might have to follow in order to maintain access to your funding? And obviously, a lot of those come to light as well, as you mentioned, through just the compilation of that diligence package. So how would you then say, all of this is compiled, you're having great conversations with, a slew of different capital providers. You move into this term sheet phase. What was your approach there at Ascend in terms of either key terms that you would look for, or how you really wanted to make sure that you were getting the best terms for your business at that right moment?
Well, I think to start off, you ideally want at least 2 term sheets. And that's for a number of different reasons. And so the way to get more than 1 term sheet, or at least get one, but ideally you want like a few, is to run a good process before that. And so just make sure we kind of close the loop on that. You're going to have the introductory call. Typically at that point, you maybe sign an NDA and then share the diligence package that I just mentioned. And then typically for those interested, they'll request a sort of second call where there's a lot of questions related to the content, which is also a good sign that shows that the investor has dug in. And that's an opportunity to maybe bring in the founder as well, if it's not being run by the founder, and tie the loop there and also introduce the founder to the whoever is running it on the investor side. But typically, as you mentioned, Callie, after that, at least on my experience, there might be some additional questions in the form of like an email or something like that, or maybe one more call. But a lot of times you'll move into this kind of like term sheet phase. So investors will either decide based on sort of the diligence package, the initial call, the second call, and the answers to your questions, whether or not they want to put forward an offer in the form of a term sheet. And so, that's another obviously critical point of the process. It could be a little challenging, I would say. You just have to manage expectations here because everybody's got a different timeline. So for example, if you've got a term sheet from a capital provider and you're kind of like really early in the process on 3 more, you got to kind of like thread the needle of not sort of I think everybody is willing to give you some time to digest it, and folks understand that it's competitive and stuff like that, but they're not going to wait forever, right? So you've got to make sure that you're running multiple processes at once in order to
Certainly.
get multiple term sheets within the same time frame. Otherwise, you're going to probably burn some bridges, or just like people are just going to say sorry. So yeah, maybe I'll pause there and see if there's any questions, and we can get into like more the kind of nitty gritty around the actual term sheet.
Was there any other kind of stage of the process that you wanted to make sure we highlighted? Maybe pre-term sheet, post diligence package compilation?
I spent a lot of time building sort of customer acquisition go-to-market teams at fintech startups. And, if you were to build like a CRM stages around this process, it would be, kind of introductory calls, diligence package, and then diligence package requested, received, and then probably there'd be like a second call or like a, kind of technical call, whatever you want to call it. And then it would be like term sheet received, right? And then term sheet accepted. And so you could think about like 5 or 6 different stages. I think there's like some nuances in there, but I think basically we covered it, Callie.
Yeah, that makes a lot of sense. Would love to dive into as well, learning from that experience. Are there any common mistakes, either from your own experience or that you've seen other companies make as well, that might be able to be prevented in the debt capital raise process?
Yeah. So a couple thoughts there. I think based on my experience, one of the biggest mistakes that early stage, companies, founders, executives, et cetera, can make is getting too attached to the interest rate as the be all and end all of the offer. So what I found helpful, and this was actually advice given to me, but what I found helpful is to create your own kind of, tear sheet, if you will, that basically summarizes all of the different term sheets, because equity is expensive too, right? So for example, if you're having to put up 15 cents for every dollar lent as opposed to 2 cents for every dollar lent, well, that equity comes at a significant cost, right? Particularly for fast growing startups. So it's actually pretty easy to put together a basic sort of model that shows like what is the true cost of this capital, both from a credit, which is just, interest rate, et cetera, fees perspective, but also from an equity perspective, whether that's warrants or just the cost of equity required to reach the full 100% advance rate. I found that to be super helpful and actually enlightening, because what it did was actually expose that some term sheets with higher interest rates were actually more competitive because they were less dilutive, in the sense that it didn't require as much equity from your company to access that capital. So even something that's 12% versus 9%, it's not like an immediate throwaway. It's let's unpack like the full details of this term sheet, both from an equity cost perspective as well as a credit cost perspective. Add those up and then sort of look at it across the different term sheets before you make a decision. And I think once you have that, it's much easier to negotiate as well. It's much easier to have those conversations, because it's not like I want this or you want that or someone's being greedy. It's just factual. It's just like, here it is compared to another one. I think that's unusual to do that at the seed stage and potentially serve founders well.
I think it brings us, full circle a little bit, right? We started this conversation talking about the importance of, as you're thinking about raising debt capital side by side with the launch of the new product, what is our go-to-market strategy? What are we looking to sell? What are the types of customers? And making sure that those goals and, business initiatives align with the criteria that you're negotiating, such that you don't fall into a situation, as you mentioned, of, okay, we're originating loans that fall outside of the credit box of this debt capital line.
For sure. Yep. It's so important. And by the way, I think most lenders are expecting some negotiation on term sheets, so it's not unusual or sort of frowned upon to negotiate. Always helps if you have more than one, of course. That can take a few weeks or maybe even a month, depending on how you're running your process. But at that point, you're sort of choosing a lender, you're signing a term sheet, if you will, and you're entering into the documentation phase. I think deals still do fall out occasionally, kind of post term sheet signed, but more often than not, it's sort of headed towards closing.